All right, well, the hyperscalers have, well, become hyper borrowers. Amazon kicking off a massive 11-part U.S. debt offering, aiming to raise at least $37 billion in the next leg of its AI build-out. Joining us right now is Robert Schiffman, who covers this space for us over at Bloomberg Intelligence. Amazon today, our stock of the hour, but we're more focused here on their borrowing binge here. $37 billion. Obviously, this is going to go down as one of the biggest bond sales, investment-grade bond sales of all time. How did the market actually take it?
They love it.
Yeah.
You know, I think the credit markets, particularly in big cap tech, are shouting loudly, the sky is not falling. There is a big difference in equity valuations and bond valuations. When they launched this deal, they were looking to do maybe 20 to 30 billion. They're going to print 37. Remember, they're going to do probably another 10 to 12 billion, even more equivalents in euros tomorrow morning. So probably printing $50 billion at levels that are some 25 to 30 beeps inside initial price talk. There are buyers out there, and they're in size.
It's such an important point that you think about what the stock market is saying when it comes to big tech. It's totally different than what we're hearing from the credit markets and the investors there. But even still, I have to imagine that an issuer like Amazon is in a league of its own, or perhaps a league of maybe just a handful of others in finding big demand for their debt.
Yeah, this is one of the goats of the technology industry, and there's only a handful. And it's those handful that are really leading the charge in terms of borrowing. And that's why people are so comfortable, because when they think out about cash flows over the future, they believe they're going to be there, and they're going to be there in size. Just think about Amazon's top line. They're probably going to be the first company to cross $1 trillion in revenues over the next couple of years. They might generate $200 billion of EBITDA this year. So if you have $100 billion of debt, so what? You have a half a turn of leverage.
Let me throw it back in your face. Amazon is Amazon, right? Okay, how does the market take Oracle coming back to the market, or Salesforce, or basically companies that maybe aren't, at least has the same veneer and sheen that an Amazon does?
Yeah, listen, all tech is not created equal. I think the sort of the Mount Rushmore of tech, whether it's Meta, Microsoft, Amazon, Alphabet, they're different. Somebody like a Salesforce that might buy back $50 billion of stock over the next year and issue $25 billion of debt.
Not for an AI build-out, to buy back stock.
Just to protect their stock. I think they're going to get beat up pretty bad, and spreads are going to widen a lot more. You're going to see demand at the right price because they're still a single A name. But listen, there's a lot more concern about software over the next 10 years, certainly over 50 years. Remember, Amazon just printed a $3 billion 50-year tranche. Oracle also is a different animal. They're reporting after the close. They have one of the largest balance sheets in the corporate bond market, now similar to what Amazon has.
And they have one of the lowest
over-levered, they generate negative free cash,
among those names.
But they're done funding for the year. They're committed to investment grade. They already did their $25 billion bond deal. They issued equity. I think the one thing that people are looking for Oracle tonight is that they're not going to raise their CapEx guidance. The equity market and the bond market right now is just a little bit sick of hearing we're spending more money and we're not making it yet. I think if Oracle hits their infrastructure and their cloud software numbers without raising CapEx guidance, we go tighter.
All right, Robert Schiffman of Bloomberg Intelligence.